Hey guys, welcome back to the Genesis Blog podcast. Today we're coming back with another thematic analysis for you guys. Today's topic is real world assets. Siddharth is going to cover that today. So without further ado, take it away.
Cheers. Thanks, Yash. Great to be with you guys again. Today, I think, we're going to cover a topic that I've been very excited about in the crypto space for a very long time. And I think that it's one of the main benefits of blockchain technology itself. It's been one of those benefits that says, oh, we're going to tokenize trillions and trillions of dollars of assets across the globe, make everything liquid, bring about financial incentives to almost every asset on the planet, because most assets on the planet are actually illiquid. And what real world asset tokenization does is, at its heart, it makes illiquid assets liquid and easily tradable, and assigns value to assets that it was not easy to assign value to in the past. So what exactly are real world assets, right? So real world assets are those assets from markets that exist completely outside of crypto, and they're subject to the dynamics present in their respective markets. So crypto is just as a vehicle to get exposure to these types of assets. So one of the main opportunities in real world assets is that you're trying to create a legal structure to mirror the on-chain transfers of tokens. So what the token would be is that it would derive its value and almost entirely from that real world asset, and therefore it's subject to all of the nitty gritties of what a real world asset is subject to in terms of regulation, legal challenges, unexpected events in the real world happening that cause the value of that asset to fluctuate, et cetera, et cetera. So, that's one very important thing to keep in mind about real world assets, and we'll be touching upon that throughout this podcast. So, tokenization essentially is the process of digitally representing an existing real asset on a distributed ledger, right? And you get all of the benefits that you get with tokenization in general that we'll touch upon later, in terms of settlement, in terms of liquidity, in terms of a bunch of different types of benefits, right? But the first place to start is talking about the types of real world asset. So Jason Chen wrote an amazing primer on real world assets recently, and he defines real world assets as two main types: birth assets and rebirth assets. Now, birth assets are when new assets are created that were not possible without without blockchain and without tokenization, while rebirth is where existing assets are reledgered. Right, so you're representing an existing asset on the ledger, on the blockchain ledger, and making it the main asset that that derives value from that underlying asset, representing essentially the value of the underlying asset on a blockchain and allowing it to be tradable between just participants across the globe. So what are birth assets, right? So birth assets are things like DAO bonds, or decentralized parametric insurance contracts. So like these are, for example, where you get pre-specified payouts based upon an event getting triggered. These events, they depend on the nature of that policy. They can be, any type of triggers, so environmental triggers, business related triggers, like for example, how many customers you're getting in a store, et cetera, et cetera. And obviously, these contracts have to be linked to the real world. They don't really exist today, but they can exist today because of the way that the blockchain represents these assets, different types of assets on its ledger, and allows them to be freely tradable, transparent, viewable by anyone across the globe, right? Rebirth assets are what a lot of people actually talk about when they talk about tokenizing real world assets. So these are established asset classes like, for example, sovereign debt, mortgages, private debt like ventures and venture capital, private equity funds, corporate loans. You have so many different types of things again, like climate assets, trade finance, anything essentially which is an asset in the real world, but can't really be traded that easily because of existing legacy issues such as extremely manual processes, paper-based processes, all of those kinds of things that that's the legacy of essentially how we used to do things in a pre-electronic world, right? So the Financial Stability Board, it actually defines tokenization as this, so as a representation of traditional assets, and yeah, an easy way to understand the tokenization of assets that exist in the real world is to think about securitization. So securitization is a technique in finance. It's a structured finance product where assets are pooled together and they are converted into a security, and shares of that security are sold to individuals, and those shares could carry claims on the rights of the to the cash flows that are backed by those to the cash flows of those assets, right? So for example, if you bundle up a bunch of mortgages together, which is what happened during the 2008 financial crisis, you can bundle up a bunch of different mortgages together, diversify the risk essentially, because you're cutting them up, slicing them up, and then selling them off to like a bunch of different people, and those people have access to a proportionate claim on the cash flows that the mortgage generates. So you can think of asset tokenization in a very similar manner, because you're either going to be representing one individual asset, or you're going to be pooling together many different types of assets with different risk profiles to create one package that can then be cut open and sent and sold to people. So that's really how I would think about tokenizing real world assets. So yeah, some of the more important use cases that are, for example, investment funds, such as private equity, venture capital funds, real estate investment vehicles, because there's a really high lack of liquidity in these vehicles today, and a lot of people, including the capital providers for these assets, for these funds, they want to have the ability to obtain liquidity and to be able to sell their stakes if if they have a real need to do so. So yeah, tokenization is thought to bring about a lot of benefits in these areas, right? And yeah, so that's kind of the first thing that I wanted to touch upon, which is actually defining real world assets. Now, yeah, I'll stop for a second to see if you guys have any questions around that.
No question, just like a comment, I guess, so people can understand it better. So the way I think about it, and Balaji Srinivasan is the one who kind of, made me understand this through his podcast with Lex. He said that blockchain is essentially a new way to create backend systems. So what that means is currently any system that's built, it's usually built, where a company has a centralized server where they store some kind of data, be it, stock data or like, data around different types of financial instruments, etc. And it's all stored in centralized servers essentially. And blockchain turns that entire thing on its head by making the whole process firstly visible to everyone, secondly decentralized, and because of that, that also adds more liquidity because more people can get involved into creating liquidity for different markets because it's decentralized and there's no kind of gated access, which is what you see with securitization, where only institutions and high net worth individuals get access to these securitized products to invest in, and it's not accessible to normal retail investor. And blockchain essentially is a completely new way of creating any kind of backend for any system, including these kinds of real world assets.
Yep, exactly.
And one thing I'll add is, on top of accessibility, tokenization, also going back to how you said tokenization is basically on-chain securitization, right? So beyond accessibility, one thing that's very important to note regarding tokenization is programmability, right? To these securities, now you have a whole nother new design space for how these tokenized assets can actually behave and interact with whatever application may be, which was not earlier possible. with traditional securitization.
Yeah, exactly. I think the programmability point is extremely important because what that does is it automates away a lot of the existing manual processes that that are there that have to be reconciled with off-chain. And if you have something that exists truly on-chain and does not need to reconcile back with any ledger off-chain, then you do get a lot of cost efficiency and savings, which actually, is a good is a good segue into the next thing that I'll be talking about, which is the benefits that that real world assets, or let's call them RWAs, they purport to offer. So in summary, there would be efficiency and cost gains, access to a larger audience of investors, transparency, and a benefit in pricing. So I'll dig a little deeper into each of these. So firstly, you get efficiency and cost gains from atomic settlement, which is essentially, settlement of an asset today is a manual process and has to be done, for example, at a clearing and settlement institution. I'm not going to delve too deeply into how settlement is done today because that's a very long, dry topic. But it's important to remember that settlement does not happen instantaneously today, and there is a it happens at T+2 essentially. So 2 days after the trade is made, or 3 days after the trade is made sometimes, right? And there have been efforts to reduce this time lag. But what this time lag does is causes a bunch of risks to show up in the system because, for example, if you conducted a trade and then it actually settles, which means it's final 2 or 3 days later, then you are exposed to credit risk. That the other person will not pay you. You're exposed to liquidity risk. So, for example, if you want access, that money is essentially in limbo, right? That asset is not really yours until the end of the time period. When it settles, you get exposed to counterparty risk, right? Like so, all of the and you have to hold essentially for that you have to hold a lot of collateral on margin. Right. So because of that, therefore, what happens is that your money just gets stuck, and that's called the opportunity cost of capital, which means it's your money, but you're just holding it in limbo, and you can't really utilize it. Therefore, the money is not really capital efficient, and therefore, what the blockchain does is actually allow for instant and atomic settlement. And atomic settlement is called delivery versus payment, right? So it's called atomic DVP. And delivery versus payment essentially means that when an asset is delivered and the payment is received at the exact same time, cutting out the time lag that happens in traditional settlement cycles. So that leads to the freeing up of capital by the institution at the time that they buy the asset. So they have access to instant liquidity, and their money is not held in limbo, essentially. And therefore, they're also not exposed to as much credit risk, counterparty risk, liquidity risk. So, that is one of the main benefits of tokenization and blockchain technology, and a whole host of clearing and settlement institutions across the world have already started looking at these applications of the technology, including the DTCC, which is the largest clearing and settlement institution in the US, right? So then that's one of the main benefits in my opinion in terms of efficiency and cost gains. And in general as well. Secondly,
just one more one more thing. I mean, the one more point is that even though like people might think, I don't care if my trade executes after 2 days and it comes in my account. What people don't realize is that account itself is not actually controlled by you directly. Like you don't own the data to that account. That's stored again on some centralized server by some government institution who's custodying your assets for you. Right. And in like blockchain tech, everything would be wallet to wallet. So you actually would own all your assets and have sole control over them with your with your private key, which you can't normally do in the traditional finance world.
Yep. Yeah, exactly. Good point, Yash. Cool. So the next point is around automation. So there can be, again, just plain vanilla automation introduced in the issuance, distribution, management of securities, servicing of securities, corporate actions like, for example, capital calls, distributions, redemptions, all of those kind of corporate actions that need to happen across the life cycle of a security can be automated. Therefore, there's efficiency gains and cost reduction that occurs through those. So yeah, like for example, smart contracts reduce the cost of issuing and administering securities, increase the speed of execution, they streamline transactions. Yeah, and there's again, another benefit is around the programmable part that for example, that Sid was mentioning, right? So the programmable part can also be extended to automate compliance with regulatory requirements, right? And that's a really useful thing, because then the regulators can just hook into the smart contract and see data that is being, see the relevant data that's being shared with them, and you know that you're compliant with regulatory requirements then. But one point to note here is that this is definitely possible, but regulators need to be able to accept automated compliance and understand blockchain data, and that knowledge gap exists today, and it's not trivial. So therefore, it will take a decent amount of time, and this is a constant theme throughout the challenges section of this podcast, that the potential of the technology is 100% there, and like it's not really the technology that's at that's really causing adoption to not skyrocket. It's actually legal and regulatory and what I dub off-chain issues that are slowing down the adoption of tokenizing real-world assets, right? So yeah, in essence, like these are the efficiency and cost gains. Then there's access to a larger audience of investors. So it could allow for direct access of investors in primary and secondary markets. So they would, like we spoke about when you're securitizing an asset, right? Investors would have the possibility to hold fractional ownership of assets. And tokenization allows for the slicing up of assets, which divides ownership into smaller claims. And this is very valuable for illiquid assets as well, because you can actually make them liquid and trade them amongst many people, diversifying the risk out and giving access to a whole lot more of individuals who want access to an asset with a different risk profile and return profile. So particularly retail investors may gain access to these asset classes and risks that have been beyond their capacity. And they can participate in cap markets in a similar manner as institutions do. There are examples of this happening already that we'll touch upon later with protocols like Centrifuge, which have started tokenizing real-world assets and offering the opportunity for individual investors to invest in them. One point I'd like to make here, though, is that there is a reason why institutions are the ones who should be touching a lot of these assets. I think that there should definitely be access to individual investors for these, but in reality, if you don't have the knowledge about the specifics of an asset, especially one that is complicated like a real world one. For example, if you're talking about factoring and you have a trade finance asset, if you don't know the nitty-gritties of factoring, if you don't know the credit history of the companies that are participating in that factoring transaction, and you're just buying access to a pool of these assets without understanding what exactly they are, at least to like a little bit of a rigorous level, then you are more likely to fall flat on your face than an institution is, because an institution has a lot of that's their job, right? Like that's what they do every day. And obviously, this kind of job of investing in assets is not a trivial one as well. So tread with caution. Don't try to invest in every real world asset tokenized product that you see. We've already seen it in the crypto space where people are going insane behind options. And if you actually think about how the options market is structured, a lot of them are actually based on the very fact that individual traders are more likely to lose money on a more regular basis than the protocol itself is, which is why the protocol can stay solvent. I mean, we saw this example with GMX, if I'm right, Yash? So
Yep.
so tread with caution, understand the products that you're investing into. It's not a GameStop monopoly. You should really understand the risks of what you're investing in.
I think this is more of an education problem than an accessibility problem.
Yeah, exactly. I mean, there is an accessibility problem, but there's definitely an education problem that's bigger.
Yeah, no, like what I mean is, I don't think this is a case to not give access to retail, even though now it's possible with tokenization. But I think it's more give them all the access and then put the burden of responsibility on them to educate themselves, as opposed to
yeah, I think that's fair, but also a little idealistic, because I think that it's not. I mean, yeah, like you're definitely putting the burden on people, and like I want to give accessibility to people, right? But also there have to be like consumer and financial protection risks. Like at some point, like you're not, like at some point you're not just giving access like without any like without abandon. There are a lot of scamsters who would really take people for a ride if you just did not have any rules or any if the barrier to entry was not sufficiently high enough. People would just get wrecked all the time, man. Like it's like there's one thing to be said about giving people access, which they should be given access, right? But there's another thing about like allowing people to get wrecked all the time and losing all their money. It's not a good sign.
Yeah, no, what I'm was having the sufficient guidelines and any let's say crutches for the retail participants, so they can use it to access it rather than having an arbitrary individual or institution deciding if they should get access.
Yeah, that I agree with.
Yeah, that's
cool.
What should be done is maybe don't curtail access. Instead, make it easier for individuals to invest in these products through decentralized means, such that replace traditional institutions that normally invest in these products with maybe DAOs that are controlled by a decentralized group of experts, and then retail investors can go and invest in these DAOs, and their funds are safeguarded because it's blockchain tech or whatever. But they also are not taking the risk of investing individually. There's still some level of trust, but it's still, it's better than what it is currently.
Yep, exactly. Cool. Yeah. So, so by enhancing, inclusivity in these kinds of assets, like for example, you could also do, you could also create pools where, SMEs, for example, can get funding by allowing any type of investor to fund their projects, right, and gain a return from the returns of that SME project. SME, small and medium enterprise. Therefore you get a flow of private financing from capital owners to small corporates, increasing capital efficiency and allocation across the economy, hopefully, right? And you give access both to retail investors who couldn't gain access to that capital, but also to like businesses that have been starved for credit, right? So that's a big benefit.
Yeah, and one thing
another benefit.
Just before we move on to the next point, one thing to note about this whole concept of accessibility is, it's only possible because it's internet native, right? Now, because all these assets and everything that we're discussing exists on the internet without the help of any entity or organization, centralized organization. That's why we are able to give access to literally anyone, right, who has an internet connection. And beyond, before Centrifuge and all the other projects that we might be discussing a little bit later on, we already saw like a case in point with Mirror, the Mirror protocol, on the late Terra ecosystem. So, and what they were doing was basically they were getting, say, like US stocks, the secure tokenized version of US stocks, and people in Bangladesh were trading them, which was half of them they could not get access to US stocks because they didn't have the financial institutions, access to the financial institutions in their native country to invest in US stocks. So this is a very important point when trying to understand why this is giving access, right?
Yeah, makes sense. Cool. The next benefit would be around transparency. So you get complete transparency depending on the blockchain you're on, but on most public blockchains, around transactional data, information around the issuer, characteristics of the asset, access to a whole host of data analytics. The way that tools like the token terminal are doing it for protocols today. You can really like imagine a robust data analytics core, like a platform that can analyze real world assets in aggregate and provide a lot of information that is easily accessible for investors across the globe on the performance of those kinds of assets, right? And I think that that's a really important characteristic of public blockchains that really shouldn't be sneezed at, because you get the type of analytics I've seen for some of these blockchain protocols is unreal. I think that we're very lucky to get that type of the analysis readily available to us. And if you just go back a few years, there was no chance that was there for any type of product, right? So I think that that's very important. And yeah, in terms of transparency, you get a clear record of ownership with certainty at any point in time. So you can eliminate, a few middlemen in today's processes like registrars or transfer agents. And yeah, like you don't need any corporate registries maintained off chain in a dusty old book. You can maintain them on chain, on ledger, accessible by everyone or accessible by whoever you deem fit, right? So I think that that's very important. And the last benefit that I will talk about is pricing. So in terms of, there's a liquidity premium that you get for investing in an illiquid asset, right? Like the asset would be worth more if you were able to make it liquid and tradable. So tokenized securities can get lower illiquidity premium or obviously higher liquidity premium, which will allow investors to capture higher value from the underlying asset, because investors expect high yields from typically illiquid assets. They carry an illiquidity premium that's above the value of that asset, right? So that dampens the value of the asset usually. Here, because you don't dampen the value of the asset, it's priced more. It's priced nearer to its fair value. So therefore, it's just more accurate pricing. In terms of liquidity, you also get greater liquidity by listing on multiple marketplaces at the same time. Like, for example, you can take into account the Zora example that we spoke about a few episodes earlier, where that Zora NFT standard was used to list an asset across multiple marketplaces. I mean, it's just the type of technology that can be used, for example, for assets. Sid, I think you want to say something? No, all good. Sorry, I thought you came on mute or something. But yeah, so you can get greater liquidity by listing on multiple marketplaces. And there would be higher liquidity because collateral is just freed up, like I mentioned. You can just mobilize that collateral a lot more efficiently. And it can just sit in, it can just be deployed to whatever use you want that capital to be deployed to. So therefore, there's a lot more liquidity in the system. And you also get reduced information asymmetries, which makes pricing easier as well. Like it makes price discovery better. So it allows investors to increase their participation and bring additional liquidity in the market. So therefore, that's one of the main benefits as well for me. So I'll pause here. Otherwise, I can move on to the challenges if you guys don't have comments or questions.
Nothing from my end.
No, not really. Just basically, with the Zora example, Zora is, built as like a hyperstructure, as Jacob himself has put it. So they are trying to be like a, core infrastructure that people can use and build on top of. And like a good example I can think of like this is that, if you look at football is a sport with like well-defined rules, etc. And all the monetization that's happened to football has happened on top, right? The core rules of football will always stay the same, but on top of that, people are building like, there's clubs, there's all kinds of money involved with it, and you can get involved with that part of it, but at the same time, you'll always get access to playing football if you have 22 players and a pitch, right? So in the same way, Zora, it allows people to do whatever they want on top of the protocol, but the core Zora protocol will always be the same no matter what, and can be used by anyone, but it can be monetized further by building stuff on top of it. And I mean, the same thing can be applied to, real world assets as well.
Yep. Cool. So now on to the challenges, and there are quite a few. So in summary, they would be legal and regulatory, custody, lack of demand in the market currently, data storage, and liquidity issues, off-chain events, oracles, and communication with the real world, essentially. So I think that those are the main those are the main challenges that are there. Starting from a legal and regulatory perspective, so like, for example, you need changes in corporate legislation. So for example, if you're issuing equity or shares on the on blockchain, you need those to be recognized as such and not just digital representations of share certificates, because a lot of the benefits that you get from tokenizing an asset and putting it on chain is if you don't have to reconcile back to like the original ledger or to the whatever exists off chain, because if you do, then you're just hamstrung by the time lags and SLAs in actually reconciling with those events off chain. So you're not really getting any benefit because all you're doing is double the work because you're representing it on a blockchain. But your main registry, if it's off chain, then then you're still for example, if settlement is only done when money goes into a fiat account, then you're still hamstrung by the T+3 settlement of into a fiat account. So it doesn't matter if the security is atomically received. It matters if there's legal precedent behind the settlement being recognized as such, right? So I would say that's you need changes in legislation. A problem is that also that economic value first accrues to the legal asset, and then secondly to the token which represents it. So the token itself is, in terms of claims on that asset, the token itself is junior to the legal claims on the real world asset that it represents, and the legal asset is actually senior in claims. So for example, if claims are paid out, token holders, how token holders would get paid out is TBD, right? So that's that's another legal issue that needs to be dealt with. Tokenizing real assets, so like it involves much more than just tracking data on blockchains. So for example, it could have real world legal effects. So like, for example, if you're transferring ownership of a shipment, there are legal things that have to happen in the background in the off-chain world for it to actually be recognized as a legitimate transaction. So there's a lot of impact and implications for actors in the off-chain world, and therefore you would avoid a lot of these problems by, if participants agree that the ledger is the source of truth, the definitive source of truth between participants in that system. But you would need a lot of work prior to that asset being tokenized before that can happen. Therefore, the entire legal structure around us has to be fitted to these assets being represented by tokens before you can actually do so with and gain all of the benefits that we've been speaking about. In terms of liquidity, right? I think that this is I'll come on to liquidity separately, but there's, for example, actual rules around liquidity of funds. So for example, if you've got a private equity fund, and depending on the fund structure that is set in, it's usually not as a registered product, right? It's usually structured as a direct fund, or a feeder fund or an interval fund or whatever. And those funds have liquidity requirements on them. There's a cap of 2% on the liquidity of that asset. So what that means is that if the fund is worth $100 million, then you can't actually transfer out more than $2 million of that fund per calendar year. So that obviously, like, even if you're tokenizing the asset and like representing it on chain, even if you actually have it digitally, you literally launch the fund digitally native. And if the legal structure in the back end is going to be a private direct fund, that is subject to the liquidity requirement, you're still subject to that liquidity requirement on chain. So you're still hamstrung by that liquidity requirement on chain, and therefore you don't get the benefits of liquidity that we've been speaking about. So that's legal precedents are very important to dig into. I think that there's another thing in that liquid institutions need to be able to tokenize real world assets in high volume. But the dam that's blocking this is that current regulatory structures are not well defined, even for security tokens, and a lot of issues exist with the SEC today, from a US context, because because a lot of the world follows what regulation the US does and looks at them to take a stand, right? And the SEC has been very wishy-washy, flip-floppy. A lot of people have complained about that. This is like one of the biggest issues that exist today, is that the regulatory agencies in the US are really not equipped or have not been able to deal with creating a good legal and regulatory framework for digital assets to date. And they're doing enforcement by they're doing regulation by enforcement, which is not a good sign, because then any project is at risk of getting an enforcement action taken against it. You would rather have a legal structure that's well defined, where what you're doing is right or wrong, right? So that's a big issue that exists today. So the legal status of smart contracts is not defined yet. In most jurisdictions, they're not considered to be legal contracts. And unless it's clarified whether contract law applies to smart contracts, it's difficult to enforce. So there will be enforcement and financial protection issues. And you need to audit the code properly. You need to set in a legal structure around that. A lot of work to be done in that regard. And the last one would be around KYC, AML, and onboarding, and continuous identity verification. All of those kinds of things also have robust, also have legal standards behind them, and regulations behind them that need to be adhered to. And it's not always very easy to and this is an understatement, it's not always very easy to define a clear onboarding process that constantly refreshes the data that goes stale, for example. So if you've done an onboarding for a platform and it needs to be refreshed, how are you going to do that? Who's going to hold the data? Lots of different kinds of issues stemming from that. So I would say from a legal and regulatory perspective, these are the biggest challenges, in my opinion. Actually, I'll stop there for a second, because I know that was a lot around legal and reg. I'll touch upon custody, market demand, etc. in a sec after you got any questions, if you do.
Yeah. So, I mean, not question, just a point that, all these institutions, especially private equity funds, venture capital funds, they all kind of thrive on the fact that their markets are illiquid, if you think about it, because every time a company goes in for a funding round, it's the VC funds that get to basically choose essentially what the valuation of that company will be, right? It's not decided by market forces, it's decided by these private institutions. So what VC funds do quite often is that they keep, pumping the price up of a company through subsequent valuation rounds. And because all of this is private, and only institutions that have a vested interest in the price of this going up get to decide the price of this company itself, it's very, very biased, and they have a vested interest in letting things continue the way it is, right? Private equity funds, venture funds, even institutions that securitize products, they don't want other people to get access to this. They want to be like the gatekeepers, so that they can kind of firstly charge really high fees for anyone who wants to invest with them, and second, they get to set terms on different deals and kind of have a lot of power. And I think the reason they are scared of blockchain tech is because this power will kind of get taken away from them. It'll decentralize access to all of these different instruments, which they don't want. So why would they support it, right?
I mean, it depends also. They do want that to a certain extent because they want their LPs to get access to liquidity. They want to increase the capital that they can get from as many sources as they can get because higher volumes of capital are always better. But you're touching upon the market demand point actually, which is very, good segue again. Like, for example, valuation is a problem. I think that the point that you touched upon is super important because, GPs, for example, may not want their trades to share at a discount. Want their shares to trade at a discount, and they don't need to provide disclosures to continuously value their funds today, right? So they may not want to send along to like firstly continuously update that data, which is not that easy. Firstly, because of the liquidity of the assets, and secondly, because they want to maintain the illusion that like even in a bear market as today, their funds are doing well and their investments are doing well, and they don't want to remark their assets. Like the biggest problem with SoftBank is that it's a public company, and Masa every 6 months has to is either on top of the world or he's crying about how his fund has lost $23 billion, and you're just going to run into issues because of that. So, and secondly, they may not also want to send along confidential data about their fund to prospective LPs who will want that data in order to invest, because that again, like it makes the data public. So valuation is definitely an issue. And that's a huge problem that needs to be solved. And I don't even know how it will be solved actually. Like that's the one thing, like a lot of the other issues can be solved. The valuation issue, I don't know how to solve yet. I haven't come across a great way to do that.
Just one point on this, for like in a liquid early stage world, wouldn't just formation of standards help it? Like, and what I mean by that is, if if all startups are essentially trading in a liquid market, to value a fund performance, wouldn't we start just looking at 3-month intervals, 4-month intervals, as opposed to daily intervals to actually evaluate the fund? Because we know that early stages is inherently volatile.
Yeah, it depends. I think that you would do that, but also that the underlying assumption is that all of these become tradable and tokenized, which is like not easy. And secondly, the problem is that a lot of these funds invest in off-chain assets that are like, for what you're saying to happen, you would have to have real world tokenization across the board. Everything would almost have to be tokenized. And your standards are correct. Like you need to set up standards, but what are those standards? Like how do you value these things? And like I don't think actually that you should value them as much, because it's an early stage startup. Like it shouldn't be held to the rigors of a public company, right? So I don't think that these necessarily should be as easily valued, because it is much more difficult to judge how they are.
Okay.
Right.
I mean, a counterpoint to this is that, tokenization of everything can also lead to a lot more speculation, right? Like, I mean, VC funds have a vested interest in the startups doing well, but at the same time, they are VC funds that are doing their due diligence, and they are going to come at some kind of fair value for the startup every time they're raising more money, right? If it's just traded, it completely it can cause a downward spiral of the price, and the founders should not have to worry about what the price of their token is. They should just have to worry about building a great product, and eventually, if they build out great products and it starts showing product market fit and they start making a profit, then it makes sense for something like that to be publicly tradable. So I mean, it's two sides of a coin. You can look at it either way. On one side, you're giving access to retail investors to get in at the bottom. On the other side, you're kind of there's like an outside, or like a pretty strong chance actually, that the startup token could be subject to lots of manipulation, and it could detract focus away from the core building process of a startup.
Agreed. Another one is that around demand is that there's not enough demand to natively tokenize a fund, for example, and also there's around the infrastructure part, right? Like institutional investors and a lot of stakeholders don't actually have the Web3 infrastructure set up to be able to custody or interact with tokens. So it's a bit of a chicken and egg problem, but you are dealing with it. You're in the real world, right? Like you need people to be able to change their infrastructure to be able to deal with these things. But what comes first, the product or the infrastructure? I think it's going to be the infrastructure. So you have to like get that into their You have to abstract their infrastructure out. You have to make it easy for them to deal with things. You have to make the UI UX very easy. A lot of things that we've been speaking about a lot in this podcast. And yeah, like that's the pathway towards adoption. Another challenge is custody. So there are no extremely well-established institutional grade custody providers who can be used by institutions apart from BNY Mellon or Fidelity. There's obviously a lot like Fireblocks, Anchorage, a lot of those other ones. But and they are like, you know, qualified digital asset custodians, all of those kinds of things. And but it's not as easy. You know, it is better for the custodians to for a bank custodian to actually be present, such as a BNY Mellon. And essentially there are pockets of custodians, but there aren't enough. So that's a market, you know, that's a market issue. And from a regulatory perspective, for example, there are regulatory requirements in the US to be a special purpose broker dealers to store tokenized securities. It's an onerous process. All financial institutions may not be willing to do that at the moment because of the ill-defined, undefined, nebulous benefits that may come out from tokenizing securities at this moment. So that's around custody. And there's another small one around data storage. So, you know, you have questions around data protection and privacy, storage of data and regulation, like GDPR in Europe. You need effective data rights management systems to be in place. And therefore you need all of those issues to you know, be resolved before you know, real world assets can be tokenized. Right? So like the right to be forgotten, all of those kinds of things. So cool. I think that that those are a few of the main challenges. I think the last big one that I wanted to talk, actually there are two more. There's off-chain events and connectivity with off-chain events, oracles, all of those kinds of things. So firstly, you know, just like stablecoins can become depegged, tokens based on real world assets can become under collateralized in an event that limits the token holder's access, you know, to the full benefits of that asset. So for example, if there's a debt or a fine, you know, there are lots of third-party rights and other events that can occur which affect the value of the tokens. For example, if there's a legal claim against the real world asset, you know, then pollution, environmental issues, insurance issues with that real world asset, intellectual property rights, blah, blah, blah. Lots of different off-chain events. So with the communication about these events, right, it's not like the holder of the token representing the real world asset can easily you know, obtain automatic notice of some of these events because they happen in the real world. It's not very easy to get access to that information. So you need a very open database to be able to get access to them, and even then you will be hamstrung in many cases. So therefore it's a bit difficult to set up a liquid secondary market because token buyers can't do as much due diligence on claims as they would want to, even though obviously like in a blockchain based ecosystem, it is easier to do it. You're depending a lot on, you know, you're depending on a lot on the oracles and the communication infrastructure that is present between the blockchain and the real world asset, right? So, you know, therefore this problem does have to be solved. Again, mentioning around the off-chain processes that need to be reconciled with, unless most service providers are integrated to the blockchain. If the you know, like for example, if a fund makes all Web3 native investments, then you know, there's no reconciliation needed because you can just track it. But for example, if they make investments into like off-chain real-world assets, then you need to reconcile with those registries and legal paperwork and all of those things as well, which is time-consuming and reduces efficiency, increases cost. So, and there's again reconciliation with off-chain services like you know, custodians, etc., that fall into the same bracket. So if there's, you know, a lack of connectivity between on-chain and off-chain interfaces, if you trade tokenized assets, risks can get fragmented, liquidity can get fragmented. So this can give rise to arbitrage opportunities across different, you know, trading venues. So that's kind of an important consideration. And if there's fragmentations of the markets on which the token trades, it could delink the token's price from the price of the underlying asset. And there could be a fragmentation there as well, which could cause liquidity issues and pricing issues and all those kinds of things. So those are definitely things that need to be kept in mind while structuring and designing a tokenized real world asset. And the last one I would say would be around liquidity. So if you trade in secondary markets, trading in secondary markets of tokenized assets that continue to be traded off chain, so you can get negative consequences to liquidity conditions at traditional exchanges, at like conventional exchanges essentially, right? So if you tokenize an asset that that is a single asset, it's difficult to have liquidity for that asset because demand for that asset is not necessarily very high, right? So it dampens the benefit of liquidity, because even if you're able to fractionalize, if you can't find a counterparty to buy it, then it's a lot more difficult to gain the benefit of liquidity. And you need sufficient demand side interest for regular trading, right, for the markets to gain depth, and for the benefits to materialize. So you need you need a lot of the market to be able to move towards such a system. You need a lot of the market to be able to tokenize, and in this case, network effects and critical mass are extremely important, because you need a lot of counterparties to trade against at all times. And for example, if you tokenize part of, for example, a fund, right? And you've got like the rest of that fund or a security that exists off chain. You could move liquidity from conventional markets to the blockchain, and you could dry up liquidity in the off-chain markets, which again causes problems, right? So liquidity issues in off-chain market, you just need to have like a consistent view of the liquidity across blockchain-based networks as well as off-chain networks. So that integration needs to happen in order to make sure that liquidity does not dry up. And the last, I think that that's mostly all of the risks and challenges that I wanted to touch upon today with regards to real-world assets. And I think that I'll stop if there's any questions.
No question. Just that it's like a very simple, kickstart type of problem, right? Like how to bootstrap, because for all of this to work, everything eventually needs to get tokenized. But the problem is no one is, kind of willing to take that first step when it comes to, institutions, because everyone is looking at each other for direction and no one is kind of getting any clear direction from one single source of truth. And that could be the SEC, but clearly even they aren't sure exactly where this can go, and they want to make sure that the US, they get to still regulate as much as they do, all of that, and they also want to make sure that tax wise everything is kind of the US is still getting its share of everything, right? So it just who will kind of take this first step and let everyone follow suit somehow.
Yeah, cool. I think that to bring real world assets, I think the next thing that I just wanted to touch upon is that the next thing that I wanted to touch upon is the kind of go to market for real world assets. And I don't think that, just to keep this episode a bit compact, I'm not going to touch upon the protocols building in the real world asset space today. I think that we'll leave that detail for subsequent articles that we publish. And so I think, the last thing that I'll touch upon, I think, is around the go-to-market for real-world assets. So the first thing would be that you need a standard, right? So think back to the securitization example. In securitization, you've got a standard called a QSIP, and QSIPs represent the security, and and this institutionalized mortgages, corporate loans, consumer loans in the 1980s. So securitization is a pretty long process, and it's just limited to a few core asset classes, blah blah blah. So a lot of those issues And yeah, so you need, for example, a common standard for originating, ledgering, packaging, and distributing assets on chain, so that everyone can follow the standard and use it. Because if you have many standards, then you're just going to have all of the issues that a lot of the issues that I mentioned above, especially liquidity ones and access ones and a lot of other ones. So like for example, what's happening today is that in many companies in the real world asset space, so they follow the SEC's classification of securities, not tokenized securities, not security tokens, but what securities existing are, which is the Howey test. And they treat tokenized versions of their of real world assets as legally equivalent to the status of that real world asset. Now, in France, SocGen, when they wanted to do they did the MakerDAO bond collateralization and borrowing of DAI last year and through this year, they adopted a CAST framework, which is a hybrid between using the underlying public blockchain as settlement while keeping an off-chain register. So you have a bit of a, you're dipping your toes into both worlds. Yeah, so those are some of the legal and regulatory standards that exist, but they don't really exist because it's really not to a very high level. Although regulation is getting better right now, right? With like, for example, the draft of the MiCA document being leaked earlier this year, which is the European legislation. But a common standard could be something like what we see in Ethereum, right? So there's so many different token standards for smart contracts. And so you've got, your ERC20s, your ERC721s, your NFTs. There's one called 3643, which is which is an ERC compatible standard for security tokens. Another one is ERC 1400, which is a standardized framework for the tokenization of securities. So it's this one could be like creating is essentially a standard that allows you to do a few different things while giving people optionality would be important. And yeah, the standards programmed to automatically enforce specific conditions that relate to legal and regulatory requirements, allows for automated compliance, whitelisting and identification of investors, KYC, ML onboarding processes, asset servicing, corporate actions, all of those are part of that standard. And yeah, so it's very important for a standard to come about, which everyone can adopt and just spin up to issue a tokenized security or a tokenized real world asset. So that obviously, like for some assets, it's going to be more bespoke, which is why the standard needs to be as broad as possible to allow for as much flexibility as possible. But it does need to be interoperable with, but the use of the standard enables interoperability between the different assets. So yeah, so that's one of the main things that needs to happen for real world assets to get socialized, more broadly. So in terms of the markets that should be targeted, now the primer by Jason Chen actually does a fantastic job at talking about which markets should be targeted. So he makes the point that DeFi has made a huge impact on the underserved because there's permissionless access to synthetic dollars, and there's individuals in countries across the globe that have access to US dollar stablecoins, so that they benefit a lot today, right? And there's high potential to expand this to businesses in the developing world as well. So now, because securitization markets in the US and EU are pretty well established, credit funds will use those to buy mortgages, corporate loans, asset-backed securities and loans. But what you do is that you use DeFi for access to less institutionalized assets like private credit, emerging market consumer and business credit, trade finance assets, revenue-based finance, so those kinds of more esoteric assets that you want access to. So you get your, many asset managers can acquire their assets from traditional avenues, a majority of them, but what DeFi can fill is the hole for that diversified minority aspect of their portfolio. And therefore, you can, for example, get access to things like tokenized government debt. Like, for example, if I'm in the UK and you guys are in India, if there's tokenized Indian government treasuries that pay out a yield of like 8 or 9%, and I can access it, then that's really useful, because then I'll get diversified, uncorrelated yield that's much higher than the yield that treasuries here offer, right? So that's a pretty interesting point. If, for example, DAOs integrate with these kinds of protocols, they could get, the same kind of benefit. And protocols like backed finance, for example, offering compliant ERC20 tokens representing US treasuries. And what a tokenization of real world assets does is that it allows DAOs and other businesses to diversify their treasuries significantly, and therefore not be exposed to crypto market risk as they have been today. So I think that that's a very important aspect of the go-to-market. So you target DAOs, you target businesses in underserved markets to provide credit to. Those are the two very important customers. And Web2 fintechs are also important. So, for example, revenue-based finance originators, trade finance asset originators, linking up with their systems, tokenizing their assets, all of those kinds of things. And I think that essentially, tokenization could be very meaningful in assets where there's efficiency gains that are very easily obtained through cost, speed, making processes easier, disintermediation, or where markets where there's a lack of trust. So those are the types of markets that are very important to target. And so wider adoption is in markets with limited liquidity and multiple layers of intermediation, right? So in developed economies, it might not be as much, but developing economies is such a good cash cow for this kind of stuff, because because these markets meet the profile in a very real way. So in terms of the go-to-market, I think that's that those are the kinds of assets that and markets that real-world assets should try to target first. I think that just to I think that we're constrained a little bit by time, and we're coming at time. So what I'm gonna do is just run through some of the stuff that I'll speak about in the article that releases later on, which will be a little more comprehensive. And I'll obviously touch upon everything that I've already touched upon, but also the different types of assets maybe. So, for example, trade finance assets, revenue-based financing, a little bit of a look into the protocols that are building today in the space. So Centrifuge, how they operate. There are a few other ones. So there's Fortunify, Rossify, what Chainlink is doing around its Oracle. So it's got a real world Oracle called Deco. There's Spectral Finance. There's Masa Finance. And then there's a couple of things that I'm super excited about, which I find, very interesting, which is around, carbon markets. So there's a couple of things there. So there's Token Protocol, which is essentially building technology to move carbon credits onto open blockchains, which is really cool. And then there's also a theory paper that I read recently, which is very interesting around around theorizing a carbon currency and what that could look like. And I thought the proposal was interesting, but also kind of flawed. So I think it'll be interesting to discuss that, in the article as well. And then the last thing that I would just quickly touch upon is around the SocGen Forge MakerDAO DAI loan that I mentioned earlier on, where Societe Generale, a French bank, collateralized, put essentially its tokenized bonds as collateral to borrow MakerDAO's DAI currency, which is pegged to the dollar. And it was a very interesting proposal that was posted directly on the Maker forums. And I think that that's very interesting to touch upon in terms of how financial institutions that can potentially go about with tokenizing real world assets, although obviously Maker is not a great example because their governance processes are absolutely Byzantine and very, very difficult to get through. But yeah, I think that these are some of the topics that I'll touch upon in the article as well. But yeah, that's it for this episode. I think hopefully it was a good peek into the world of real world assets and tokenizing these, and what benefits and challenges exist, and how we can go to market with this, hopefully. So yeah, that's it from me. Yash, said if you got anything else.
Just one last closing point is that all of this crypto innovation that's happened so far doesn't mean anything unless we can actually implement it in the real world, which is, what this whole episode is about. Otherwise, it's just in its own siloed ecosystem where you're trading one crypto asset for another, and that's cool, but neither actually have any real bearing on the real world. So we do need to start tokenizing real world assets much more than people realize for blockchain tech to actually succeed. It's the only thing that matters.
Exactly.
That's
Cool.
right.
Perfect. I think that's it from us today then, and see you guys soon. And yeah, have a great one, guys, and cheers. Thanks for listening in.
See you guys.
Cheers, guys.